Nicola, would you please start us out?
Is this on? Can you hear me? Okay, good. Thank you very much. And obviously, Joe and Chris, thanks so much for including me in such distinguished panel today. The topic of conversation is the resolution of complex banks. So I thought that in order to set the stage, I would be actually talking about complexity of banking institution. And I will, in fact, actually go beyond banks. So despite Dick's resistance, I will be mentioning SIFIs, so above and beyond just the SIBs, even though I will not be using any acronym in my presentation. So let me just jump right into it. So there has been a lot of talking about bank complexity in the last few years, and for obvious reasons. All the reasons actually have been discussed in the last couple of days at our mini conference, so I don't need to explain and motivate why complexity of banking institution is an important topic nowadays. It is also an important topic regarding what to do about the issue of complexity. So there are a number of ex-ante solutions to the problem. You can break up institution, you can capsize, you can altogether restrict activities, or you can intervene after the fact by putting together proper, effective resolution programs. But despite what you want to do, I think there hasn't been enough conversation, and that's my personal point of view, on what I call dynamic consideration. In other words, we haven't really addressed enough the issue of where the complexity of banks come from. So in other words, why is it that we have nowadays a large number, actually, of banks with dozens and dozens of subsidiaries under their control, in some cases actually thousands of subsidiaries, where in fact depository institution, which is what we typically consider a bank, represent a tiny percentage of their own organizational structure. So why is it that banks have evolved into such complicated animals? So I want to be upfront about my approach. I take an organizational approach to the problem. It is not the only way in which you can define complexity, but it is the one that I choose to, it is the way I use to define complexity. So I focus on the number and the types of subsidiaries that an organization controls, and which I think actually is a natural way to address the important policy issues that are on the table. So the resolution, the issue of systemic importance, and one that is also dear to me, although this is probably the topic for another mini-conference, is whether, in fact, having to deal with complex institutions require complex regulators. So what are the boundaries of regulatory entities, and how do you actually manage the job of a regulator? But again, we won't be talking about that today, I think. So let me start talking about the evolution of complexity on the banking side, because after all, we will be talking about the SIBs, the complex banks. The common explanation, the common factor that you hear talking about is usually regulation. In other words, changes in regulation are the reason why banks are so complex today. And I think that there is truth to it, at least for the United States. The process of geographic deregulation that took place starting in the 1970s and through the 1990s definitely allowed banks to reach that scale sufficient to then expand the organizational boundaries of these firms well beyond commercial banking. And the Gramm-Leach-Bliley Act of 1999 is definitely the piece of legislation that sanctions that process by introducing financial holding companies and therefore allowing for, essentially, it's like opening the gates to allow for this process to complete. But in my opinion, to think that that regulation causes complexity is just an oversimplification of facts. And the main reason for that, and quite obvious, is that regulation itself is simply something that adjusts endogenously as a result of internal pressure coming from the industry and from markets. And so the case in point of the building up of complexity, if you think about it, the repeal of Glass-Steagall It was something that had been brewing for a long, long time, decades, definitely before the Financial Modernization Act of 1999. And in fact, actually, one of my favorite examples is mentioning the last bullet point, the Proxmire Financial Modernization Act of 1988. I don't know how many people are are familiar with the Proxmire Financial Modernization Act. I think very few people. Essentially, in 1988, Senator Proxmire wrote this bill, which was very much similar to the Gramm-Leach-Bliley Act that passed 11 years later. And it actually passed the Senate with 98 votes. So there was some consensus about it already 11 years before. Then it died of miserable death trying to reach the House. I don't know exactly the political economy reasons for it. But the bottom line is that this process of transformation from a regulatory standpoint had been going on for a long time. And so that essentially leads me to this other slide, which is my favorite explanation for this process of transformation of the industry. It doesn't have to be the only explanation, but I think it's an important complementary one. And it is essentially suggesting that banks have adapted their organizational structure to remain viable financial intermediaries as the financial intermediation industry was changing around them. So my story is a story where the technology of financial intermediation changes. And this is something that I and many other colleagues at the New York Fed have been working on for a number of years now. But just to summarize it in a couple of bullet points, the idea is that we go from the relevant model of intermediation through the 1980s that had a central broker, typically a commercial bank, as the financial intermediary. Deposit-taking, loan-making operation really defined what a bank was. And so with that particular model of intermediation, you expect from an organizational perspective firms that will be focused in depository taking type of activity with not much expansion of organizational footprint. Things changed with financial innovation, asset securitization probably being the centerpiece. With asset securitization, we transition from a bank-centered model to a decentralized system where you can complete the process of financial intermediation through the concomitant intervention of a number of different specialized entities that don't have to be banks. Most of them are not banks, but they are providers of specific inputs in this sort of assembly line, what became popularized as intermediation chains. Okay, so this is essentially what we call today the shadow banking model of financial intermediation. And so with this transformation in the industry, you expect to observe the emergence of essentially what I'm defining here as conglomerated specialists. So the banks transition from being a pure commercial bank entity into instead much more complex financial conglomerates where they acquire and they incorporate under common ownership and control the entities that become important in the modern process of intermediation. So they go from commercial banking into the space of specialty lenders, underwriters, asset managers, broker-dealers, insurance firms, and so forth and so on. And they definitely did a lot of it. I can't really go into the details of this picture. This is a reference to a paper that I wrote recently with Jamie McAndrews and James Traina, so you can look at the details there. But the bottom line is that banks did buy a lot of non-bank institutions in the last 30 years. So that's basically quickly an explanation of how banks have become complex. Again, this is an idea, a proposal for discussion, which takes me, however, to something that is broader than that. And so this is the world of hybrid intermediaries, which is the title of my talk today. In evolutionary biology, a successful hybrid is an offspring of two species that in a new environment is better suited for survival than its own parents. And so the idea here is essentially that the evolution in the financial ecosystem essentially is what drives the emergence of hybrid intermediaries. And so the idea is that the bank holding companies, the SIBs, G-SIBs, the largest one that we observe today, are exactly an example of hybrid intermediaries. You have the commercial bank, you have the broker-dealer, you have the insurance company, the asset management subsidiaries, and so forth and so on. None of them independently complete the process of financial intermediation, but the aggregation of these activities and the interconnection among themselves is what make that particular financial conglomerate a successful financial intermediary. And I think that this is a key point to make. It is a key point to make, and that's my second bullet point, because there is no reason that this process of transformation that I just described, that starts from the commercial banking sector and goes into the broader financial industry, could not be also followed by non-bank financial firms. And the main reason is that you don't need essentially a regulatory authorization to operate as a shadow bank. That's the whole point. You don't have to be a prudentially regulated firm unless you get designated as such to be a successful intermediary. And so this is where I wanted to expand the scope of our conversation, because a lot of that actually took place. This is, again, another picture from the paper with Jamie, describing the history of mergers and acquisition in the entire financial industry, not just in banking. And I'm not going to describe the numbers, but the bottom line, the key point of these slides is that there has been a lot of cross-sectoral acquisition and mergers going on, not just banks buying non-bank institutions, but asset managers, broker-dealers, insurance companies buying firms of a different kind. So this progressive expansion of the organizational footprint has been prevalent and not just limited to banks. Let me give you an example more specific to a number of firms, try just to tease you a little bit with this type of analysis. So I looked, it's actually very difficult to look at the details of the organizational structure of firms unless you are a regulated entity subject to reporting requirements. So typically we have perfect knowledge of the organizational structure of bank holding companies. And we can see exactly what is the structure of their ownership and control. There is an exception to the rule. In other words, there are firms that became bank holding companies right in the aftermath of the Lehman event. And we all know that the reason why they became bank holding company was to gain access to government support. They had not planned on expanding their depository institution ownership, nor did they initiate the process in the past. And the point is that, but we do know that those firms were important financial intermediation firms, and they were non-bank. And the point that I just want to make is that hybrid intermediaries are going to be firms that will have a very similar organizational structure, regardless of whether they come from the commercial banking world or whether they come instead from the non-banking world. And so the picture here is basically showing on the left-hand side, the yellow, brownish, those would be these, what I call the accidental bank holding companies. You don't need to squint your eyes to look at the numbers. The point here is, again, that if you look at those firms, this is Ali, CIT Group, American Express, Discover, Goldman, and Morgan. And if you compare their organizational structure to three of the most important bank of origin bank holding companies, JPMC, Bank of America, and Citi, it's very hard to really tell which one is which. If I were to remove the first row with the name of the firms, you wouldn't really tell which one is which, okay? So that's basically one point that I wanted to make. Let me give you another example, this time honing in on one particular activity. So I'm talking about securities lending here. This is something that I've been working on in the last few months. This is actually a perfect example of a modern credit intermediation chain. This is as shadow banking as it gets. There is a lot of different type of entities and markets that are involved in securities lending, and there are very well recognized financial intermediation activities and financial intermediation risk that certain entities bear in the process of completing a securities lending intermediation chain. And for the longest time, the entities that were the dominant providers of these intermediation services in securities lending were, guess what? Banks, or I should say hybrid intermediaries of a bank origin. State Street, Boni, JPMC, Citi, Northern Trust, they dominate essentially the provision of these services. Until a couple of years ago, when a firm coming from the asset management firm, BlackRock, essentially exploded their role as a financial intermediary, providing financial intermediation services in the process, going from basically zero to now having a size in terms of financial intermediation activity larger than Citi and Northern Trust. And the bottom line there is exactly, I'm done, I'm at the conclusion, the next slide, is exactly that in the space of securities lending activity, from an organizational standpoint, you could not distinguish BlackRock from any of these 5 firms. So let me conclude. I have suggested the emergence and growth of hybrid intermediaries as a natural adaptation to an evolving system of intermediation. And this process comes from the bank side, which leads us to the complex GSIBs that we were talking about, but the transformation comes from the non-bank side. So that would be the space of the GSIFIs that are just as important. And the implication for resolution, which is the topic of the conversation today, I think are absolutely first order. First of all, we need to understand whether when you go and resolve a firm, whether breaking apart this firm into pieces will in fact actually produce potential social damage, because some of these components may be in fact part of an integrated process. Maybe that's an obvious point, but I think we should bring that up. And also, and this is the last point, because the problem is not just the SIBs, these are not just the prudentially regulated entities that we're talking about, I think we also have to take into account the fact that whatever regulatory fixes that we talk about, whether ex ante or ex post, could in fact simply mean a reshuffling of things in the shadow. In other words, you're not going to eliminate the potential systemic problem that you want to address. You are simply going to reduce the scope of one entity to increase the scope of another one. I'll stop there.